All right, everybody. So let's just review the opportunities and all of that for the ES and crude. The first thing to note is obviously the there are actually three things that maybe I should explain this one second. So I'm going to explain what this means. You probably heard it a lot. People talk about it and all of that. It's called context. Right. So what is the context? You can't trade by not knowing context because it creates a lot of errors. So you have to know context. Context is just higher time frame. All right. Context is just higher time frame. Specifically, the elements are trend. Context is the higher time frame, and the rest here that I'm explaining is what I'd be looking for: trend, breakout, and rallies. All right. Why? Why do you need to know this? All right. Because. All right. Oh shoot. Alright, so what are the three directional indicators? You can call them whatever you want, KPI, and I don't know what. You can just call them edge, whatever you want to call them. But the thing is, these are the three directional indicators. Alright, so it's higher time frame. I should have mentioned that. Okay, so context is a higher time frame. And what are the three directional indicators that context gives you? It's the higher time frame trend, the higher time frame breakout, and the higher time frame rallies. All right. So all three of these together tell you what direction to trade in oh no, not like that. What all right, so these three things these are the three things that tell you what direction to trade in. All right, so you have to answer this question: what direction do you trade in? Now the mistake here this is the mistake: not knowing the above three things or trading against them. All right, so basically you need to know, and I'll just give a simple example. All right, so let's say you have your moving average, whatever it is you're using for trend, higher highs, higher or lower lows, or whatever, or averages, crossing, whatever, right? Now this is just one piece of the puzzle, because a lot of times these things they turn later than price action, right? So from price action perspective, you need to see here you will have a breakout bar. Okay? And then you're looking for follow through, which turns the breakout into a rally. All right, so 1, is your trend, however you measure it. There's so many indicators, I don't want to get into it, but moving averages, when price is above those moving averages, with the big waves being, the impulse waves being on the upside, that's basically trend, right? And 2 is your breakout bar. So over here, you will have so over here you will have a bar that is big, and then a rally is the follow through. So this is your context. And there's actually one more, I should have mentioned this. I don't know how I missed this, but that's the 4th piece. All right, so you're 1, 2, 3, and 4. You have your trend, breakout, rally, and this level. So that level tells you all right. So the top 3 trend, breakout, rally tells you what direction to trade in, and the 4th tells you where to find trades or where to look for trades. All right. So 1. Okay. So this is your higher time frame. All right. So these are the 4 things: trend, breakout, rally, support, and resistance levels. This frames your context. These are the 4 things you have to know before putting on. These are the 4 things that you have to know before trading. And these 4 things are what people miss, because the mistake is all right. The mistake is not knowing context and just looking at 1 minute or 5-minute chart by itself. It's a major mistake, major mistake, and this is responsible for losses on top of losses on top of losses. Years of trying to become a profitable trader and not being able to is because of this. Looking at one intraday time frame and trying to quote unquote read the market. If, for example, let's say you're looking at a 5-minute chart all day, that's a mistake. Because first of all, it's a big waste of time, but you have to understand where to look for trades are at levels. So there's no point at looking at any other place until it goes to that level, and then maybe you can be alerted, and then start looking for it. Everything else, every other level, every other, is pointless. So this is a key thing. 1, 2, 3, 4. You need to know the trend. However you measure it, there's so many ways to do it. Rising amaze. Or whatever it is that you're looking at, right? But basically the top 3 things. All right, so I'm gonna just keep it really simple here, right? So 2 is the rallies, the impulse waves are like that. And then you have breakout bars. And I'll show you all of this on the chart. Like, it's not rocket science. You'll see it very clearly how the breakout bars can be identified. The trend can be identified, the rally can be identified, and the level can be identified. You do nothing until it goes to that level. Everything else is a waste of time. It's all manipulation and randomness and all of that. Meaning there's inducement, meaning trying to get you in and then stop you out and stuff like that. All right. So I want to make this very clear on what is context. It is higher time frame, 4 indicators. All right. The 4 indicators, 3 of them are directional. Trend, the direction of the breakout plus follow through of the breakout, turning it into a rally. And then the 4th is where to find trades, is the level. And this can be done many ways, right? So I'm not going to go over it again over and over, but this is based off of, zones. It's based off of breakout and test. It's based off of swing POC. It's based off of high volume areas. It's based off of all of that. It can be a spring upthrust, right? So this one here, I did it based off of the near the pivot. This is going to be around the first green bar. Again, the first green bar after the last red bar, the first green bar, which initiated the move up around that first green bar, because that's where the entire buying pressure came from. So that's your quote unquote zone. It's around the first green bar. Some folks have this term called order block, which they think it's the last red bar. But a lot of times it won't touch the last red bar. It will only go within the first green bar. And the other thing to remember is if you have a lot of follow through, chances are it will only go to the resistance becoming support, which is your breakout level. If you have a lot of follow through, meaning you have a big rally and it's pulling back, chances are it's not going to go to the first green bar of that rally. It will go to the prior high, which is the area that was broken, and that resistance will become support. So those are your price-based levels. Volume-based levels will be areas where you have high volume. So those can be support resistance levels as well. So the idea, and you will know because, if you're trading, you know what your levels you're looking at. What you don't want to do, and I know some folks that are just using averages, even the averages, like they'll use a 20 and a 50, or on an intraday basis, they use a 50 and 100. And they're looking between that 50 and 100, that area between the 50 and 100 for a reversal. Price moves back between and dips below the 50, and it's between the 50 and the 100 MA, and they're looking in that gap between the 50 and the 100, with the 50 MA being on top of the 100. So As soon as it penetrates the 50 MA, they're looking for a reversal. So that's another way to do it. These are like price and indicator based support, resistance levels. So whatever you use, the idea, it needs to pull back and it needs to go to demand areas. So that's what I'm trying to. And other people will use like below the 50, they're looking for it to break the 50% retracement, because that's when they want to start looking for the trade, because the belief is that the 50%, below that 50% is considered discount prices. So the point is, don't look for trades up here. All right, because if you're looking for trades up here, you're going to lose money. You have to let it go back down, right? And the more major point is that you're trading and having this in mind. The three indicators that I mentioned, trend, breakout, directions, and the follow through in creating the rally, will tell you what direction to trade in. And then you just have to wait. You know, you're going to put a line or something to alert you when it's below certain levels to start looking for trades, etc. All right. So this I will show you now. I'll show you a trade. Okay. All right. So I think I have to show you on crude. All right. So on crude, we're just going to. I'm going to show you. Listen. All right. So the first three indicators what I clearly explained to you is trend, breakout, and rally. Again, trend, breakout, and rally on a higher time frame. Since we're going to be intraday trading, we're going to look at hourly as our higher time frame, but you can use the daily. Like this is perfect. Daily. You could use the 3 hour or 4 hour, you know, one higher time frame, okay? I'm using the hourly because it gives a lot of trades and I don't want to sit all day. So we see that before the breakdown, the breakouts were to the downside, and now we have a breakout here to the upside. We have another breakout here to the upside, right? And this one, the indicator is catching. So the breakout bars are to the upside, but you need all three indicators. You need trend. Are we above the moving averages? Yes. Upsloping finally becomes upsloping here. And you have the breakout bars that are breaking these highs. How do you know that these are breakout bars? They have to break the high and they have to be big bars. All right. This bar here, this green bar, is the biggest bar in 12 bars. You could tell by this indicator I have here, BT since. What does it say? It says 12, meaning that's the biggest bar in 12 hours. That's meaningful on this time frame. All right? But again, you take that with trend. If you don't have trend, it doesn't mean shit. All right? So we have trend. On top of that, we have breakout. Now, do we have follow through? Right after that, we have a red bar, so I don't like it. But after that, we have a green bar, so I do like it. Meaning you have some degree of follow through, making higher highs and preferably higher closes. So higher high, higher low, higher close. Good. This is the breakout, higher high. This is the high, low, close. Here you have higher high, higher low, higher close. Okay, I like it. There's follow through. All right. So we have trend. We have breakout bars. See the breakout? Biggest in 12 bars above these highs. And we have rallies is impulse wave. All right. So we have, all right, we have 1, 2, 3. What is the fourth piece? The fourth piece is the level. All right, let's find the level. All right. So level will depend on how much follow through there is. If you have a lot of follow through, the level will typically be around the resistance area, meaning resistance becomes support, based off of a price-based level. If you have not a lot of follow through, chances are it's going to pull back all the way to near the first green bar. In this case, it pulls back into the first green bar near the last red bar, meaning near the pivot. So we're looking at this area. All right, and it's also nice because it's testing the original breakout right here. All right. So we have the fourth item, which is level. Do we do anything until it comes to that level? No, I don't do nothing. And look what happened when price came to this level. Look at the size of this bar. This is the biggest green bar, meaning the biggest up bar in 33 bars when it came back here. That's good. That's a good indication. So you see, I have the three things: trend, the direction of the breakout bars, plus the rally, the impulse waves. These three things are giving me directional, whether I have to trade long or short. And the next thing now is level. So level, depending on the amount of follow through, based on price, will either be on the high that was broken to test the breakout, or it will be near the low, meaning the first green bar, the last red bar, within that area. So it goes there and then boom. All right. So I have my context with these four things of trend, breakout bars, rallies, plus level. Now what do I have to do? I just have to wait for a price to go there to see how it reacts. And you know how it reacted? Look at how it reacted when it tapped that level. When price tapped that level, it gave the biggest wave up in 19 waves. 19 waves. After that, the sellers did come in strong, but only to spring that level and go back above it with a nice big bar right here. So usually they will not get back below the lows, right? But sometimes they do, and it rejects. So this time, when it went to the level, you had heavy buying activity. After you had heavy buying activity, they just do a little shakeout and then immediately come back. So they spring the level. And then after that, you can't really do anything about this. It's just chop mode. You just have to be patient. And now it's attempting to trend up. And we'll see where this uptrend goes. You don't really know, but chances are typically if it's holding like that, it should take out the high of the hourly chart. Just like here, take out the high. Just like here, takes out the high. Take out the high. Attempt to take out the high again. All right. So I've showed you how to look for context. Put the line. Do nothing until it gets to that line. When it gets to the line, and the context, you understand the context. You place the line waiting for a price to go to it, to that level, and then seeing how it reacts. As it reacts favorably, meaning if I want to buy a pullback, when it goes to the pullback level, there should be heavy buying, and I can see that in the size of the buying waves. After that, it's an execution procedure, meaning price comes back down and gives me, an entry opportunity. All right. So today's lesson is about context. Now, here's the mistake that you will make if you don't understand context. You'll be looking at this chart and just not, I don't know what you'll do. You just short or long. You don't understand what the hell's going on here. Short or long or short, long, You'll just be in limbo. But if you go to the higher time frame chart and you understand these three things, you have a very clear bias. Either I go long or either I go short. And you will not make the mistake of switching sides and losing money and what is it called? Revenge trading. And there's a lot of damage that can be done. If this is not understood, what happens is there's a lot of revenge trading. Like, not understanding context, what happens is you're going to look at this and it'll be a chop fest. Right? So if you go short underneath these lows, you'll get taken out. And if it pulls back and you decide to go long, you'll be taken out here. And if you re-enter after this bar, you'll be taken out there. You don't know where to put the stops. So if you decide to go short, you'll be taken out there. So in this way, you're only looking for longs and putting a stop below the lows. You're not getting taken out. You just, so anyway, I don't have anything else to share, but I've explained these things, that there are three clear directional indicators, and that creates the context, that are part of context, the trend, the breakout bars, the fall through that creates the rally, which are impulse big waves, and then the level. Putting that context now with a lower time frame entry model is what will allow you to execute. And the rest is just planning, just how to move stops, where the initial stop goes, where the next stop, the trail goes, and all of that. All right, thank you. Have a good day. Bye.